Weird times, Dylan. Very weird times, and trying to interpret what's happening is super difficult. I know you spend a lot of time looking at the macro environment. I'm trying my best to always understand it, and most of the time when I'm making shows, it's so I can understand how best to plan my finances. I'm significantly older than you, so I haven't got many years left where I can actually plan a retirement. And it's like, do I want my money in Bitcoin? Should I have some more in gold? Should I have some more in property? What's happening in the macro environment? So it's always good to get someone like you on to just talk about that and talk about what's going on. And we're in very weird times. We have a cancelled country. We have treasury bills now being essentially returning like 2% or something with 7.9% inflation. So some people are buying those and giving away 7% on the table, 8% on the table, 5% on the table. It's weird fucking times. What are you looking at?
Yeah, I mean, like, I think, first off is that, we have, I have, but I think we kind of agree that we have this thesis that Bitcoin is the best money the world's ever seen. And it's undergoing its monetization process that will be very volatile. But ultimately, the end game is that, whether you believe Bitcoin is just a reserve asset or digital gold, I think we think that it'll eventually be a unit of account for value in the world. That's the kind of multi-year, multi-decade thesis. We're not there, obviously. But yeah, totally weird times. I think we're at the end of this long-term debt super cycle where craziness, not only in like the financial markets, but just the world in general is going to ramp up. The 2020s are going to be probably look back in history as like when a lot of crazy shit went down. And so, starting with obviously with COVID, but really if we, and we've talked about this, we had a show with Greg Foss and I, we talked about kind of the everything bubble and Bitcoin's role in that. And, things have ramped up since then. I think that was last April. Bitcoin was cruising to all-time highs. But now we see kind of broad-based consumer inflation. When inflation's hidden in the asset prices, the policymakers, central bankers can get away with it. Now it's hitting consumers' pockets. It's hitting energy markets, commodities, and people are upset, rightfully so. And so, the Fed and really, like, interestingly, the credit markets are in a really tough place where they're starting to sell off, and you have rising yields in a historically over-indebted economy. And I think that leads to some pretty crazy places if we continue on this path.
Explain that credit markets thing. What actually is happening so people can understand.
Yeah, so essentially, everyone likes to look at equities or maybe Bitcoin, but really the kind of the driver of a lot of things under the surface is the fixed income markets. So the key thing to understand is that price of these bonds or these securities are inverse to yields. So as people sell fixed income instruments, say because you're receiving a fixed 2% payment when inflation's at 8%, people sell these securities, and what happens is the price falls and the yields go up. So for, say, a treasury bond, people are selling treasuries, whether it's long dated or short dated. And because of that, you see these yields starting to rise. Same with like corporate debt or anything else, mortgage-backed securities. And so right now, because of this inflationary environment, because inflation was not transitory like all of the policymakers and quote unquote experts said, we see yields really like almost going vertical. Selling off in a big way. And so, the second order effects of that is that everybody with debt in this economy and in a credit-based fiat system, everybody is, basically incentivized to be up to their eyeballs in debt. Everybody is now facing increasingly so higher financing costs, basically a higher cost to roll over all this debt, whether you're corporates, whether you're, the US government, everybody. And so it'll be interesting because there's traditionally there's somewhat of a breaking point in terms of liquidity, in terms of kind of this slow, but I think gradually then suddenly deleveraging process that we're in, where the Fed will be essentially forced to monetize a bunch of debt and implement yield curve control probably into an inflationary spike, or let the house of cards collapse. I think it's somewhat binary at this point.
Okay, let's go through both. Explain what yield curve control is. Yeah,
so essentially, the Fed's traditional buckets of monetary policy is interest rate monetary policy, moving the Fed's funds rate up and down. They kind of exhausted that weapon back in the Great Financial Crisis when the rates hit zero. So they turned to quantitative easing. So they just bought debt securities on the open market, stuff markets with cash. I mean, it's a little more complex than that, but that's essentially what happened. Did that for on and off for 10 years, tried to wean markets off of it, and the markets had a tantrum. We get to COVID. There's kind of this unprecedented economic slowdown that's a result of forced lockdowns. And a result of that is governments, households, corporates, because of how much funny money they threw at this coronavirus problem. Now we have debt at all-time highs, across the economy, across the economic sectors. And so, because they exhausted their first bucket, their first tool, which is that interest rate policy, and they really over the last decade, but over the last 2 years especially, exhausted their kind of quantitative easing, which is a fixed amount of purchases at any price. They're trying to, and I think over the next day or two, they're going to, I guess, officially end that program at the same time that credit markets are really selling off. And so yield curve control is, in theory, an unlimited amount of purchases at any price to keep bonds at a certain price level, saying that we're going to be a buyer at any price of this security, whether it's treasuries or mortgage backed or corporates. And I think that's ultimately probably the end game. And you see central banks like Japan already doing this. The difference is Japan or other central banks that have implemented this aren't the world reserve currency, and they're just not the size of the U.S. credit markets. They're not the risk-free kind of rate in the world, and we're seeing that dynamic change. But I think ultimately that's when Bitcoin probably bids to infinity, is if and when we get to that point.
We also have, as you mentioned, the chance that the house of cards will collapse. I'm not sure if somebody allows that to happen. My assumption is there would be avoidance, but I don't know what a collapse would feel like or look like. I could argue we're in the early days of a collapse. I've done the basic research of reading When Money Dies, and you feel like we're living through the first chapters of that book.
Yeah, so essentially, we've seen plenty of debt bubbles, and no doubt we are in a debt bubble throughout history. And how those debt bubbles are resolved is depending on kind of the circumstances. Right now, we have a fully fiat-based system. So say in the Great Depression, when there was a huge private debt bubble, all that credit contracted, it burst, that malinvestment was liquidated, but ultimately there was kind of that gold collateral that it kind of collapsed back onto. And so, there was bank runs and all the like, but those fiat promises, those IOUs could collapse back onto a hard monetary asset. Now there's nothing backing except credit itself. And so the solution for the last 40 years to any debt bubble burst was more stimulus, lower rates, kinds of Keynesian economic response. But now we're at a point where the Fed's fund rate at zero, inflation is at 40, soon to be 50-year highs, and everyone's up to their eyeballs in debt. Approximately 400% debt to GDP. Federal government debt to GDP is over 100%. So there's no way that they can, that we can get out of this, or that they can kind of let it collapse. But what a collapse would look like is that essentially when commercial banks or money is created, it's through credit expansion, it's through lending. When a commercial bank lends money, it actually creates money. But when a default happens or a repayment, that money is destroyed. So the reason why these kind of the great financial crisis or COVID or potentially what is coming in 2022, it happens so fast and the volatility explodes is because, and these kind of the leverage cascades is because money is destroyed. And so the asset liability mismatch, all of a sudden, you're less creditworthy because the asset you thought you had isn't actually there. So you have to sell additional assets to cover your liabilities, and it just compounds across the entire economy. And so ultimately, that leads to literally everything going to zero, and like a societal kind of. It sounds very dark, but it leads to just a complete economic collapse. And ultimately, it's not politically feasible, which is why the response will be eventually more printing, more stimulus, more monetary expansion. How far they let it get, we'll see.
But could that not lead to a different kind of collapse, or do you think that is a way of pushing the burden onto other people, onto pensions,
Yeah, I guess really when you're talking about a fiat currency, and if you look at say government debt, you can look at private sector debt or corporate debt or anything else, but with government debt. With a fiat currency, history has shown, and just kind of political incentives show that that creditors or that debtors, governments won't nominally default, meaning they won't just say, oh, you're not going to get paid because they have a printing press. And the Fed is supposedly independent, but not really.
Nominally paid and
So you'll be
purchasing power paid are very different things.
Yeah, you'll be paid out. Whatever that that funny money dollar buys you is an entirely different discussion.